So you made money trading crypto last year. Congratulations. The IRS also wants their cut, and figuring out exactly how much that can be extremely complicated. That's what we're going to go break down today. So here's the thing about cryptocurrency taxation that nobody tells you. The IRS is essentially applying decades old tax rules to a brand new technology, and the current tax code was written in 1986, more than 20 years before Bitcoin even existed. Congress hasn't passed comprehensive crypto tax legislation, so we're working with guidance that was never designed for digital assets. So I'm an EA or enrolled agent with the IRS who's been navigating crypto taxation since, basically as long as crypto has been around and we've been having to deal with taxes. I've helped clients report everything from NFT sales to DeFi yield farming to cryptocurrency payments for services. And I'm going to walk you through exactly how crypto is being taxed right now, at least the best of our knowledge, not how it should be taxed, not how it might be taxed in the future, but how the IRS is actually treating it in 2025 from what we know. So fair warning, some of this won't make perfect sense, and that's not your fault. It's tax policy trying to catch up with revolutionary technology. But all right, here's the foundation. So the IRS treats cryptocurrency as property, not currency. Yes, I know cryptocurrency has currency in the name, but the IRS doesn't care. So according to the IRS Notice 2014-21, cryptocurrency is classified as a property. So that means it's like stocks, real estates, collectibles. That notice issued back in March 2014 is still the primary guidance we're working with today. So what does property classification mean practically? 3 things. Number 1, every crypto transaction is potentially taxable. So when you trade Bitcoin for Ethereum, taxable. When you buy an NFT with crypto, taxable. When you use crypto to buy a car, also taxable. Number 2, you're recognizing gains and losses on every transaction, even if you never convert back to dollars. This is where people get in trouble. They think that trading crypto means, trading crypto for crypto means no taxes yet. That's just wrong. According to the IRS sees each trade as disposing of one property and acquiring another property, which means you realize gains or losses on each trade. Number 3, your cost basis is holding period reset with every transaction. So this matters for you whether you pay short-term or long-term capital gains rates. So hold crypto for more than 1 year, long-term capital gains rates, which range from 0 to 20%, depending on your income level. If you own it less than a year, you get short-term capital gains rates, which are taxed as ordinary income at your regular tax bracket, which can be as high as 37%. So let me give you a hypothetical example to illustrate why cost basis tracking matters. So imagine someone was making 150,000 or 150 crypto trades in a year. They start with 10,000 and with 12,000. And they assume they owe taxes on 2,000 of gains. But if they didn't track the cost basis properly for each individual trade, they can't prove their losses to the IRS. The IRS will only see the gains on winning trades, which could result in a tax bill of tens of thousands of dollars in gains, even though the net result was only a $2,000 increase. So this is why meticulous record keeping is absolutely critical. And as of right now, a lot of crypto platforms are pretty terrible still at tracking cost basis and tracking, how much money you exactly made on each trade. Okay, so let's get specific about what actually triggers taxes in the crypto world. So selling crypto for US dollars, obviously taxable. You bought Bitcoin at 20,000, sold it at 60,000. You have a 40,000 capital gain. Pretty straightforward. Trading one crypto for another, also taxable, even though you're staying in crypto. According to Revenue Ruling 2019-24, you trade Bitcoin for Ethereum, you're disposing of Bitcoin and realizing any gain or loss, then acquiring Ethereum at a new cost basis. Using crypto to buy goods or services, also completely taxable. So let's say you bought Bitcoin for 10,000 and now it's worth 15,000. You use that Bitcoin to buy a $15,000 car. You just triggered a $5,000 capital gain that you owe taxes on. The IRS sees this as selling your Bitcoin for $15,000 and then buying a car with that cash. So you're spending an appreciated property, getting paid in crypto, taxable as income at their fair market value when you receive it. Getting paid in crypto, taxable as income at a fair market value when you receive it. So if your employer pays you half a Bitcoin when Bitcoin is trading at 60,000, you have 30,000 of ordinary income reported on your W-2. Then when you eventually sell that Bitcoin, you calculate capital gains or losses from that 30,000 basis. Yes, you can potentially get taxed twice on the same crypto. Once as ordinary income when you receive it, and once as capital gain when it's sold. That's how property taxation works. So this is where things get even more messy because the IRS hasn't provided completely clear guidance. So we're working with interpretation of general tax principles applied to crypto. When you say stake your Ethereum or insert any other crypto and receive rewards, that is taxable when you receive it. Or is that taxable when you receive it? Is it taxable when you claim it? Or is it taxable when you sell it? So according to Revenue Ruling 2023-14, issued in July 2023, you have taxable income when you gain dominion and control over the tokens. So essentially when you actually use or sell them, but what exactly does dominion and control mean for a liquidity pool token? For locked staking rewards, the guidance doesn't spell this out precisely, so different tax professionals may have different interpretations. Selling an NFT for crypto is taxable, but here's the complication. NFTs may be treated as collectibles under certain circumstances, which means a 28% maximum tax rate, capital gain rate instead of the usual 20% maximum for other capital assets. IRS Notice 2023-27 issued in March 2023 indicates that NFTs should be classified as collectibles if they represent artwork or certain other items. But the notice doesn't provide completely clear, bright line test for when this applies. You just sort of have to interpret. Airdrops and hard forks create similar ambiguity. You wake up one day and have new tokens in your wallet from an airdrop or hard fork. Is that taxable income? So according to Revenue Ruling 2019-24, yes, when you have dominion and control over the tokens, it's taxable. But what if you didn't request the tokens? What if you can't access them yet? What if they have no established market value? The ruling provides general principles, but it doesn't address every specific scenario. So let's talk about actually reporting this to the IRS and the new rules that are about to make compliance both hopefully easier and more strictly enforced. Right now, you're supposed to report all crypto transactions on Form 8949 and Schedule D, the same forms used for stocks and other investments. Every single trade. So if you made 500 trades, you're listing 500 transactions with dates, cost basis, sales proceeds, and gains or losses. Starting with the 2025 tax year, there's a question on the front page of the Form 1040 that asks, at any time during 2025, did you sell, receive, exchange, or otherwise dispose of any financial interest in any virtual currency? Notice it does not say taxable transaction, it says any transaction. This is a yes or no checkbox. If checking yes flags to the IRS that you have crypto activity they should expect to see reported. So here's what's about to change everything. Starting in 2026, crypto exchanges will be required to report transactions to the IRS on a 1099-B, just like stockbrokers do. So this comes from the Infrastructure Investment in Jobs Act passed in November 2021, with final regulations issued in 2024. Exchanges like Coinbase, Kraken, Gemini, they'll all be sending you and the IRS documentation of your sales. So what this means practically, first, the IRS will know if you don't report your crypto. They'll receive the same 1099-B you do, and their computer systems will automatically flag mismatches between what was reported to them and what appears on your tax return. Second, cost basis tracking becomes absolutely critical. If you can't prove what you originally paid for crypto, the exchange might report zero basis to the IRS, which means the IRS would assume 100% of your proceeds are taxable gains. Third, claiming you didn't know you had to report crypto won't work anymore. The IRS, not that it worked before, but the IRS will have documentation proving you had transactions. All right, so here's what you actually need to do with this information. First, start tracking everything immediately if you haven't been. Use crypto tax software. There are several reputable options, including CoinTracker. I'm a big fan of Coinly, CoinLedger, TaxBit. These platforms connect to your wallets and exchanges automatically. And they calculate your gains, your losses, your cost bases across all your transaction. The cost varies by transaction volume, but it's substantially less expensive than paying a tax professional to manually reconstruct months or years of trading history. Second, understand your cost basis method. Most people use first in, first out, which means first crypto you bought is treated as the first crypto you sold. But you might be able to use specific identification if you have contemporaneous records that identify which specific units you're selling at the time of each transaction. Why does this matter? FIFO, or first in, first out, might force you to sell your oldest, most appreciated crypto first, triggering larger gains. Specific identification gives you more control, but you need documentation created at the time of the transaction, not reconstructed during tax season. Third, consider separating your holdings. Set up different wallets or accounts for crypto you plan to hold long-term versus crypto you're actively trading. This helps prevent accidentally selling long-term holdings and triggering higher short-term tax rates when you intend to sell short-term holdings. Fourth, understand that unlike stocks, cryptocurrency is not currently subject to the wash-sale rule. The wash-sale rule prevents you from claiming a tax loss on a security if you buy substantially identical securities within 30 days before or after the sale. That rule, found in Section 1091 of the tax code, only applies to stocks and securities, not property. Since crypto is classified as property, you can currently sell crypto at a loss, claim the tax deduction, and immediately buy it back. Congress has proposed extending wash-sale rules to crypto, but as of 2025, it hasn't been enacted yet. So this creates a tax planning opportunity, but one that may not be around indefinitely. So here are 3 additional things worth knowing. First, if you donate appreciated cryptocurrency that you've held for more than 1 year directly to a qualified charity, you can generally deduct the fair market value and avoid paying capital gains on the appreciation. So this is the same tax efficient strategy that wealthy individuals use with appreciated stock. And now it's available for crypto under the existing charitable contribution rules. Second, if you hold cryptocurrency on foreign exchanges, you may have additional reporting requirements. If the total value of your foreign financial accounts exceeds $10,000 at any point during the year, you're required to file FinCEN Form 114, also known as FBAR, or Foreign Bank Account Report. So whether crypto on a foreign exchange constitutes a foreign financial account is still somewhat unclear, but many tax professionals recommend filing to be safe. So penalties for failing to file an FBAR start at $10,000 for non-willful violations and can reach $100,000 or 50% of the account balance for willful violations. So this is not a minor compliance issue. Third, keep detailed records of everything. Transaction dates, amounts, fair market value in US dollars at the time of each transaction, the purpose of transactions, and records of any transfers between your own wallets. The burden of proof is on you to substantiate your cost basis and the tax treatment of your transactions. If you can't provide documentation during an audit, the IRS can assess tax based on their interpretation, which will virtually always result in a higher tax bill. Look, crypto taxation is complicated because we're applying traditional property tax rules to innovative digital assets, and the guidance hasn't kept pace with how people actually use crypto. But complexity doesn't eliminate your reporting obligation. So here's what you should do right now. If you haven't been reporting crypto transactions, consult with a tax professional who has experience with cryptocurrency about getting into compliance. The IRS has voluntary disclosure programs that provide more favorable treatment than being caught during an audit. Second, if you're actively trading or using crypto, implement a tracking system immediately. So download a complete transaction history from every exchange or wallet you've ever used. The longer you wait, the harder this becomes, especially if exchanges shut down, change their data, retention policies, etc. Third, subscribe to this channel because crypto tax rules are evolving rapidly and staying informed is the best way to avoid expensive mistakes. If this was helpful, please leave a comment telling me what crypto tax topic you want covered next. There's a lot more to discuss, including mining, DeFi, lending, crypto, retirement accounts, international tax considerations, etc. But until next time, cheers. And as a disclosure before signing off, this is all educational. For your own purpose, your own tax situation. Make sure you're consulting a tax professional to get individualized guidance. Until next time, cheers.